Most people think investing begins with opening a brokerage account or buying their first stock. But that is not where it actually starts. The true foundation of investing is built long before any money is moved. It is built in your mindset, in your relationship with money, and in your understanding of risk versus reward. Without this internal infrastructure, even the most sophisticated strategies will collapse under pressure. You must first recognize that money is not just a number in your bank account. It is a tool, a scorecard, and a responsibility. The emotional discipline required to hold an asset during volatility, or to walk away from a hot tip, is forged here at this foundational level. This is where you audit your financial behaviors. Do you spend impulsively? Do you avoid looking at your statements? Do you confuse saving with investing? These questions matter more than any stock pick. Investing is not a game of luck. It is a system of delayed gratification, probabilistic thinking, and continuous learning. If you skip this layer, you are building on sand. The market does not care about your intentions. It only responds to your actions, and your actions are shaped by your foundations. This is why 90% of new investors fail within the first 2 years, not because they picked the wrong ETF, but because they never built the psychological and behavioral scaffolding required to survive market cycles. Start here. Not with charts, not with apps. Start with yourself. The second pillar of this foundation is financial literacy, not the kind taught in schools, but the kind that actually applies to real-world decision-making. You need to understand basic concepts like compound interest, inflation, liquidity, and opportunity cost, not as textbook definitions, but as living forces that shape your financial outcomes daily. For example, if you do not grasp how inflation silently erodes purchasing power, you might think keeping money in a savings account is safe, when in reality, it is a slow bleed of value. Financial literacy also means knowing the difference between assets and liabilities, between income and cash flow, between speculation and investment. These distinctions are not academic, they are survival skills. Many so-called investors lose money because they confuse speculation, betting on price movement, with investing, allocating capital to productive assets. That confusion stems from a literacy gap, not a strategy gap. And literacy is not static. Markets evolve, instruments change, regulations shift. What worked in 2010 may be obsolete in 2025. You must commit to lifelong learning, not as a hobby, but as a non-negotiable requirement of participation. Read annual reports. Study macro trends. Understand tax implications. This is not optional. It is the price of entry. Third, you must establish a baseline of financial stability before you even consider deploying capital into markets. Investing is not an emergency fund. It is not a way to make up for poor budgeting. If you are carrying high-interest debt, living paycheck to paycheck, or have no buffer for unexpected expenses, you are not ready to invest, you are ready to gamble. The math is simple. If your credit card charges 20% APR and the market average is 7% annually, you are losing 13% per year by prioritizing stocks over debt repayment. That is not investing, that is financial self-sabotage. Stability means having at least 3 to 6 months of living expenses in liquid, low-risk instruments. It means knowing your monthly cash flow, what comes in, what goes out, and where the leaks are. It means automating savings before you automate investments. Only when this stability is in place can you begin to allocate surplus capital with intentionality. Otherwise, you will be forced to sell during downturns to cover bills, the exact opposite of sound investing. Stability is boring. It is unsexy, but it is the only platform from which intelligent risk can be taken. Fourth, define your personal investment philosophy, not based on influencers or headlines, but on your own values, goals, and constraints. Are you investing for retirement in 30 years? For a house in 5? For passive income next year? Each goal demands a different strategy, asset allocation, and risk tolerance. A 25-year-old saving for retirement can afford to ride out volatility. A 55-year-old cannot. Your philosophy must also reflect your psychological tolerance. Can you sleep at night if your portfolio drops 30%? If not, you need a more conservative allocation regardless of what experts say. Too many investors adopt strategies that look good on paper but break them emotionally in practice. That is not a market failure, it is a self-awareness failure. Write down your rules. I will never invest more than X% in a single asset. I will rebalance quarterly, no matter what. I will ignore short-term noise. These are not restrictions, they are guardrails. They prevent you from becoming your own worst enemy. Your philosophy is your compass. Without it, you will chase every trend and panic at every dip. Fifth, understand that time is your most powerful asset, and your most underestimated one. The earlier you start, the less capital you need. The later you start, the more risk you must take to catch up. And risk is not something you want to force. Compounding does not care about your excuses. It only responds to consistency and duration. A 25-year-old investing $300 per month at 7% annual return will have over $700,000 by age 65. A 35-year-old doing the same will have less than half that. That is not a market prediction, that is math. And yet, most people delay investing because they think they need more money or better timing. You do not. You need discipline. You need routine. You need to start now, even if it is small. Small, consistent actions compounded over decades outperform large, erratic bets every time. Do not wait for the perfect moment. There is not one. Start where you are. Use what you have. Build momentum. Time is non-renewable. Every month you delay is a month you can never get back, and a month where compounding did not work for you. Sixth, separate performance from process. Beginners obsess over returns. Professionals obsess over systems. A lucky trade does not make you a good investor. A losing month does not mean your strategy is broken. What matters is whether your process is sound, repeatable, and aligned with your goals. Did you do your research? Did you stick to your allocation? Did you avoid emotional decisions? If yes, then short-term results are irrelevant. Markets are probabilistic, not deterministic. You can do everything right and still lose money in the short term. You can do everything wrong and get lucky. Judge yourself by your process, not your P&L. This mindset shift is critical. It removes the emotional roller coaster. It allows you to stay consistent. It turns investing from a stressful gamble into a calm, mechanical execution. Track your decisions. Review them quarterly. Refine them, but never abandon them based on temporary outcomes. Process over performance. Always. Seventh, accept that you will never know enough, and that is okay. The market is too complex, too dynamic, too vast for any one person to fully understand. Even Nobel laureates get it wrong. Even billion-dollar funds blow up. Humility is not weakness, it is wisdom. The goal is not to predict the future, but to position yourself to survive any future. That means diversification. That means margin of safety. That means avoiding leverage unless you fully understand the consequences. Arrogance is the fastest path to ruin. The moment you think you have figured it out, the market will humble you. Stay curious. Stay skeptical. Stay open. Read opposing viewpoints. Challenge your assumptions. The best investors are not the smartest, they are the most adaptable. They know what they do not know, and they build systems to protect themselves from their own ignorance. That is not failure. That is professionalism. Eighth, build your infrastructure. This means choosing the right brokerage, understanding fees, setting up automatic contributions, enabling tax-advantaged accounts, and learning how to read statements and performance reports. None of this is glamorous, but all of it matters. A 1% fee might seem small, but over 30 years, it can cost you hundreds of thousands in compounded returns. A poorly structured account can trigger unnecessary taxes. A manual process invites procrastination and inconsistency. Automate what you can. Simplify what you cannot. Your infrastructure should make good decisions easy and bad decisions hard. Set calendar reminders for rebalancing. Use apps to track net worth. Block out time quarterly to review performance. Treat investing like a business because it is. Your future self is your most important client. Serve them with systems, not hopes. Ninth, measure what matters. Do not track daily portfolio fluctuations. Track progress toward your goals. Are you on pace to hit your retirement number? Are you increasing your savings rate? Are you reducing debt? These are the metrics that actually move the needle. Obsessing over short-term market noise is like checking your weight every hour. It is meaningless and destructive. Set benchmarks. Review them annually. Adjust if necessary. But ignore the daily headlines. The media profits from your anxiety. Your job is to stay focused on the long game. Create a dashboard, not of stock prices, but of personal financial health, net worth growth, savings rate, debt-to-income ratio, emergency fund status. These are your real KPIs. When you measure the right things, you make better decisions. When you measure the wrong things, you invite chaos. 10th, acknowledge that this foundation is not a phase. It is a permanent layer. Even professional investors revisit these principles constantly. Markets change. Life changes. Goals change. But the core mindset, literacy, stability, philosophy, time, process, humility, infrastructure, metrics remains. This is not level 1 to be checked off and forgotten. This is the operating system that runs beneath every decision you will ever make as an investor. Master it now or pay the price later. There are no shortcuts, no hacks, no secret formulas, just fundamentals applied consistently over time. If you build this correctly, everything that comes after, every strategy, every asset class, every advanced technique will rest on solid ground. Skip it, and no amount of sophistication will save you. Start here. Stay here. Build from here. At level 2, you are not trying to beat the market, you are trying to survive it. This is the stage of mechanical execution. Setting systems that remove emotion, reduce friction, and enforce discipline. The goal is not brilliance, it is consistency. Most investors fail not because they lack intelligence, but because they lack structure. They make impulsive buys. They panic sell during corrections. They forget to rebalance. They chase performance. Level 2 eliminates those failures by design. You automate contributions. You set fixed allocations. You schedule reviews. You remove decision points. This is not lazy investing. It is intelligent risk management. Humans are emotional creatures. Markets are volatile environments. The intersection of the two is where fortunes are lost. Level 2 creates a buffer between your impulses and your portfolio. The first mechanical rule: automate everything. Set up automatic transfers from checking to investment accounts. Schedule automatic purchases of index funds or ETFs. Enable dividend reinvestment. The less you have to decide, the less room there is for error. Behavioral economics shows that people are far more likely to follow through on actions that require no active choice. If you have to log in, think, and click buy every month, you will skip months. If it is automatic, you will never miss a beat. Automation also removes the temptation to time the market. You buy regardless of whether the market is up or down, which, over time, is the most effective timing strategy there is. Dollar cost averaging. You do not need to predict peaks and valleys, you just need to show up consistently, rain or shine. That is how compounding works, not through genius but through repetition. Second, adopt a fixed asset allocation and stick to it. Decide your stock/bond/cash split based on your risk tolerance and time horizon. Then rebalance religiously regardless of market conditions. If stocks surge and now represent 80% of your portfolio when your target is 60%, sell enough to bring it back down. If bonds outperform and stocks dip below target, buy more stocks. This forces you to buy low and sell high. Not because you predicted it, but because your system demands it. Rebalancing is one of the most powerful and most ignored tools in investing. It enforces discipline, controls risk. It harvests gains without emotion. Set calendar reminders. Use robo-advisors if needed. But do not skip it. Left unchecked, allocations drift. And with them, your risk profile. A portfolio that was moderate at age 30 can become aggressive by age 40. Not because you chose it, but because you neglected it. Third, cap your exposure to individual positions. Even if you are investing in broad index funds, avoid putting more than 5 to 10% of your portfolio in any single stock, sector, or thematic ETF. Concentration risk is silent until it explodes. One bad earnings report, one regulatory change, one scandal, and your entire year's gains can vanish. Diversification is not about maximizing returns. It is about minimizing catastrophic loss. You do not need to pick winners. You need to avoid losers or at least limit their damage. This rule applies even more if you dabble in individual stocks. No matter how sure you are, no matter how much research you have done, cap it. The market does not care about your conviction. It only cares about probabilities. And the probability of any single company failing is always higher than you think. Fourth, implement a cooling-off rule for all new investments. Before buying any new asset, stock, crypto, fund, whatever, wait 72 hours. Write down your thesis. Define your exit criteria. Calculate how it fits into your existing allocation. If after 72 hours it still makes sense, then proceed. This simple rule eliminates 90% of emotional, FOMO-driven purchases. It forces you to think in writing, which reveals flaws in logic you would not see in your head. It also prevents you from reacting to headlines, tweets, or friend tips. Most opportunities that feel urgent are not. The market will still be there in 3 days. If it is truly a good investment, it will not vanish. If it does, it was never an investment. It was a gamble. Use the cooling-off period as a filter. Only the strongest, most rational ideas survive it. Fifth, create a no-go list, assets, strategies, or behaviors you will never engage in. Examples: no penny stocks, no leverage, no day trading, no investing based on social media tips, no chasing 10 times tokens. Write it down. Print it. Put it next to your monitor. This is your behavioral firewall. When temptation strikes, and it will, you do not debate. You consult the list. Is this on my no-go list? If yes, stop. No exceptions. This list is not restrictive, it is liberating. It frees you from the mental energy of constant decision-making. You do not have to wonder if you should do something. You already decided you will not. Professional athletes do not debate whether to skip training. Surgeons do not debate whether to sterilize tools. Investors should not debate whether to break their own rules. The no-go list turns discipline into policy. Sixth, track your behavior, not just your returns. Keep a simple journal. Date, asset, reason for buying/selling, emotional state, outcome. Review it quarterly. Look for patterns. Do you buy when you are excited? Sell when you are scared? Chase performance after headlines? This is where you uncover your blind spots. Returns tell you what happened. Behavior tells you why and how to fix it. Most investors never do this. They focus on P&L and ignore the psychological drivers behind it. That is like treating a fever without diagnosing the infection. Your journal is your diagnostic tool. It does not need to be complex. One sentence per trade is enough. But it must be honest. Brutally honest. Because the only person you are fooling is yourself. Seventh, limit your exposure to financial media. Turn off notifications. Unfollow finance influencers. Avoid market update YouTube channels. The noise is not information, it is distraction dressed as insight. 95% of what is published daily has zero impact on long-term outcomes. But it has 100% impact on your emotional state. Fear sells. Greed sells. Calm does not. So the media amplifies extremes. Your job is to mute it. Check your portfolio once a month, not once a day. Read annual letters, not hourly tweets. Consume information on your terms, not the algorithms. Create a signal versus noise filter. If it does not affect your 5-year plan, ignore it. This is not ignorance, it is focus. The most successful investors are not the most informed. They are the least distracted. Eighth, build redundancy into your system. Have backup access to accounts. Share emergency instructions with a trusted person. Use password managers. Enable two-factor authentication. Document your strategy in a simple one-page summary. Assume you will be hit by a bus. Is your family or executor able to step in without chaos? This is not morbidity, it is responsibility. Too many portfolios become frozen or mismanaged because no one knew what to do. Write down where your accounts are, what your allocations are, who your beneficiaries are, what your goals are. Update it annually. Store it securely. This protects not just your wealth, but your legacy. Investing is not just about growth, it is about stewardship. Act like it. Ninth, measure adherence, not performance. At level 2, your KPI is not, how much did I make? It is, did I follow my rules? Did you automate? Did you rebalance? Did you stick to allocation? Did you avoid the no-go list? If yes, you succeeded regardless of returns. If no, you failed even if you made money. This reframe is critical. It shifts your identity from trader chasing gains to investor executing a system, and systems compound. Gains do not unless they are part of a system. Review your adherence monthly. Grade yourself. Celebrate consistency, not luck. This builds the right habits for the next level. 10th, accept that level 2 is not temporary. It is your permanent operating system. Even as you advance to more sophisticated strategies, these mechanical safeguards remain. They are your immune system, protecting you from behavioral viruses. The temptation will always be there to go off script, to chase a hot stock, to time a correction, to deviate from allocation. Level 2 says, no. Not because you cannot, but because you should not. Mastery is not about complexity, it is about consistency. The greatest investors in the world do not have secret formulas. They have unbreakable routines. Build yours now. Defend it forever. At level 3, you move beyond mechanical execution and begin to design your portfolio with intention. This is not about picking individual assets. It is about constructing a system that aligns with your life goals, risk capacity, and time horizon. Asset allocation is the single most important decision you will ever make as an investor, far more impactful than stock selection or market timing. Studies show that over 90% of portfolio performance variability is explained by asset allocation, not by security selection or tactical moves. Yet most investors obsess over the 10% and ignore the 90%. Level 3 forces you to reverse that. You stop asking, what should I buy? And start asking, what structure will get me to my goal with the least unnecessary risk? This is strategy, not speculation. The first strategic principle. Define your goals in measurable, time-bound terms. I want to retire is not a goal. It is a wish. I need $1.2 million in 25 years to generate $48,000 per year in passive income. Adjusted for inflation is a goal. Without specificity, you cannot design a portfolio. You cannot measure progress. You cannot make rational trade-offs. Each goal requires its own investment bucket, with its own time horizon, risk tolerance, and asset mix. Money for a house down payment in 3 years? That is conservative, mostly bonds and cash. Money for retirement in 30 years? That is aggressive, mostly equities. Money for a child's education in 15 years? That is a glide path, starting aggressive, becoming conservative over time. Mixing these goals in one portfolio leads to conflicting decisions, and usually bad ones. Separate them. Structure them. Fund them independently. Second, understand that risk is not volatility. It is the probability of failing to meet your goal. Most investors fear short-term price swings. Professionals fear permanent loss of capital or insufficient growth to reach objectives. If you are 25 and saving for retirement, a 30% market drop is an opportunity, not a disaster. If you are 60 and relying on withdrawals, that same drop could be catastrophic. Your risk tolerance must be calibrated to your liabilities, not your emotions. This is called liability-driven investing. You do not manage risk in a vacuum, you manage it relative to what you owe the future. Calculate your required return, the minimum annual growth needed to hit your goal. If it is 5%, you do not need to chase 15% returns, and you should not, because the risk required to get there could blow up your plan. Strategy is about sufficiency, not maximization. Third, implement strategic asset allocation using globally diversified, low-cost index funds. Do not try to outsmart the market. Do not overweight your home country. Do not avoid asset classes you do not understand. Learn them. A globally diversified portfolio includes domestic equities, international developed equities, emerging markets, real estate, REITs, government bonds, corporate bonds, inflation-protected securities, tips, and possibly commodities. Each serves a purpose. Equities for growth, bonds for stability, real assets for inflation hedge. The exact mix depends on your goal and risk budget, but the principle is universal. Diversify across uncorrelated return streams. This does not eliminate risk, it optimizes it. You accept market risk, but avoid concentrated, uncompensated risks like single stock exposure or sector bets. Fourth, use risk budgeting, not just allocation. Risk budgeting means assigning your risk dollars intentionally. Not all assets contribute equally to portfolio risk. A 60-40 portfolio may seem balanced, but if equities are 3 times more volatile than bonds, 90% of the risk may come from the equity side. That is not 60-40. That is 90-10 in risk terms. Risk budgeting forces you to ask, where is my risk actually coming from? And is that where I want it? You may decide to reduce equity exposure and add low volatility factors, or increase bond duration, or add managed futures, not to chase returns, but to better distribute risk. This is advanced but essential. You are not managing percentages. You are managing exposure to loss. That is what matters. Fifth, incorporate factor investing systematically, not speculatively. Factors are persistent sources of return. Value, momentum, quality, low volatility, size. You do not chase them tactically, you embed them strategically. Instead of just US large cap, you might tilt toward value and profitability. Instead of generic international, you might add a momentum or quality screen. These tilts are not about predicting short-term winners. They are about harvesting long-term premiums that have persisted across decades and markets. But, and this is critical, only use factors that are 1. Academically robust, 2. Implementable at low cost, and 3. Aligned with your risk profile. Do not layer on complexity for complexity's sake. Factor investing is a refinement, not a revolution. Done right, it improves risk-adjusted returns. Done wrong, it becomes expensive noise. Sixth, build tax efficiency into your allocation from day one. Asset location matters as much as asset allocation. Place tax-inefficient assets, like bonds, REITs, high-dividend stocks, in tax-advantaged accounts, IRAs, 401ks. Place tax-efficient assets, like broad market index ETFs, in taxable accounts. Use municipal bonds if you are in a high-tax bracket. Harvest tax losses systematically, not emotionally. Never let tax considerations override strategic ones, but always optimize within your strategy. A 1% tax drag may seem small, but over 30 years, it can cost you 20 to 30% of your ending wealth. Tax efficiency is not about evasion, it is about stewardship. You earned the money. Do not give more of it away than necessary. Seventh, stress test your portfolio against realistic scenarios, not imaginary ones.
Run Monte Carlo simulations.
Test against historical crises. 2008, 2020, 1970s inflation. Ask, if the market drops 40% next year, does my plan still work? If inflation averages 5% for a decade, am I protected? If I lose my job and cannot contribute for 2 years, do I have margin? This is not fear-mongering, it is contingency planning. Most portfolios are optimized for the recent past, not the uncertain future. Stress testing reveals hidden fragilities. Overconcentration, insufficient liquidity, unrealistic return assumptions. Fix them now, not during the crisis. Build buffers. Add redundancies. Reduce leverage. Assume things will go wrong because eventually they will. Resilience is the hallmark of strategic investing. Eighth, integrate liquidity planning. Not all money should be invested for the long term. You need operational liquidity, emergency fund, tactical liquidity, opportunities, and goal-specific liquidity, upcoming expenses. Define how much you need when you need it and where it should be held. Emergency fund, 3 to 6 months in cash or money market. Tactical reserve, 5 to 10% in short-term bonds for opportunistic buys. Goal liquidity, laddered CDs or T-bills maturing when you need the cash. Liquidity is not idle money. It is strategic optionality. Prevents forced selling. It enables disciplined rebalancing. It reduces anxiety. Without it, even the best portfolio can be derailed by a surprise expense. Plan for life, not just markets. Ninth, review and recalibrate your strategy annually, not reactively. Life changes. Goals shift. Risk capacity evolves. Your portfolio must adapt, but not to headlines. Set a calendar date. Review your goals. Reassess your risk tolerance. Check your progress. Adjust allocations if needed. This is not market timing, it is life alignment. A promotion may allow you to save more. A child may change your time horizon. A health scare may reduce your risk appetite. Your portfolio should reflect your reality, not a snapshot from 3 years ago. But, and this is crucial, do not change strategy based on performance alone. If your process is sound and your goals unchanged, short-term underperformance is noise. Stay the course. Calibrate for life, not for markets. 10th, document your strategy in a formal investment policy statement, IPS. This is not bureaucracy, it is accountability. Your IPS should include objectives, constraints, asset allocation, rebalancing rules, risk tolerance, liquidity needs, tax considerations, and behavioral guidelines. Write it, sign it, review it annually. This document becomes your anchor during storms. When fear or greed whispers, do something, you consult your IPS. It reminds you why you built the portfolio you did, and what you agreed not to do. The best strategies fail without governance. The IPS is your governance. It turns discipline into policy. It transforms emotion into procedure. At level 3, you are no longer reacting, you are architecting. And architects work from blueprints, not impulses. At level 4, you begin to look under the hood. You move beyond index funds and start evaluating individual securities, not to gamble, but to enhance your strategic portfolio with high conviction, fundamentally sound positions. This is not stock picking for thrills, it is analytical investing for edge. You are not trying to find the next meme stock, you are trying to identify mispriced assets with durable competitive advantages, strong balance sheets, and competent management. This requires deep work. Reading financial statements, understanding business models, assessing moats, modeling cash flows. It is time-intensive. It is complex. And if done poorly, it is dangerous. But if done well, it can materially improve risk-adjusted returns over time. This is not for everyone. But if you choose to go here, do it with rigor, not hope. The first analytical rule: never buy what you do not understand. If you cannot explain the business model in one paragraph, do not invest. If you do not know how the company makes money, who its customers are, what its costs are, and what its competitive threats are, you are speculating, not investing. Warren Buffett's circle of competence is not a suggestion, it is a survival rule. Start narrow. Master one industry, then expand. Do not jump from tech to biotech to commodities because they are hot. Depth beats breadth. Understanding beats diversification at this level. You are not indexing anymore. You are underwriting. Treat every investment like a small business acquisition. Would you buy this company if the stock market closed for 10 years? If not, do not buy the stock. Second, learn to read financial statements, not headlines. The income statement, balance sheet, and cash flow statement tell you what is real. Earnings press releases and CEO interviews tell you what they want you to believe. Focus on revenue trends, gross and operating margins, return on equity ROE, return on invested capital ROIC, free cash flow generation, debt-to-equity ratio, and working capital efficiency. These metrics reveal quality. A company growing revenue but burning cash? Red flag. A company with high ROIC and low leverage? Green flag. Ignore non-GAAP earnings. Focus on GAAP net income and, more importantly, owner earnings, free cash flow minus maintenance capex. Numbers do not lie.
Executives do.
Go to the source. Third, assess the quality of management, not their charisma. Read the CEO and CFO letters in annual reports. Listen to earnings calls, not for guidance, but for candor. Do they admit mistakes? Do they explain failures? Do they focus on long-term value or short-term stock price? Check insider ownership and compensation structure. Are executives eating their own cooking? Are they paid for performance or just for showing up? Management quality is a moat. A great business with bad management becomes mediocre. A mediocre business with great management can become great. You are investing in people, not just products. Evaluate them with the same rigor as the financials. Fourth, understand valuation, not price. Price is what you pay. Value is what you get. Learn discounted cash flow, DCF, analysis. Learn comparable company analysis. Learn precedent transactions. You do not need to be perfect, you need to be directionally correct. A DCF does not tell you the right price, it tells you the price at which your assumptions break even. If the market price is below that, you have margin of safety. If it is above, you are betting on perfection. Always demand a margin of safety. Even great companies can be bad investments if you overpay. Use multiple valuation methods. Cross-check them. If they all say overvalued, listen. If they conflict, dig deeper. Valuation is not math, it is judgment informed by math. Fifth, analyze the competitive landscape. What is the company's moat? Is it brand, cost advantage, network effects, switching costs, IP, or regulatory? How wide is it? Is it widening or narrowing? Who are the competitors? What are their strategies? What are the barriers to entry? A company growing in a fragmented, low-barrier industry is at constant risk. A company dominating a high-barrier niche is more durable. Read industry reports. Study market share trends. Understand the value chain. Investing is not just about the company. It is about the ecosystem it operates in. A rising tide lifts all boats until it does not. Know which boats have holes. Sixth, stress test your assumptions. Every investment thesis rests on assumptions. Growth rates, margins, interest rates, competition, regulation. Write them down. Then ask, what if I am wrong? What if growth slows by 2%? What if margins compress by 5%? What if a new competitor emerges? Build bear, base, and bull case scenarios. If the bear case still generates acceptable returns, you have resilience. If the bull case is required for profitability, you have fragility. Invest in resilience. Avoid fragility. The market does not pay you for being right. It pays you for being right when others are wrong. That requires surviving when your assumptions are challenged. Seventh, track key performance indicators, KPIs, specific to the business, not just stock price. For SaaS, ARR, churn, CAC, LTV. For retailers, same-store sales, inventory turnover, gross margin. For banks, net interest margin, loan loss provisions, ROA. For industrials, utilization rates, backlog, input costs. These are the vital signs. If they deteriorate before earnings do, you have early warning. Set up alerts. Monitor quarterly. Compare to guidance and competitors. This is not micromanaging, it is active ownership. You do not need to check daily, but you must know what to check and when. Ignorance is not patience, it is negligence. Eighth, practice position sizing with analytical conviction. Not all your research will be equally strong. Allocate more capital to your highest conviction, highest margin of safety ideas. Use a tiered system. Core, 10% max. Satellite, 5% max. Speculative, 1% max. Never let a single position exceed your predetermined cap, no matter how sure you are. Conviction must be tempered by humility. Even Buffett's best ideas have failed. Size positions to survive being wrong, not just to profit from being right. This is risk management disguised as allocation. It turns research into actionable strategy, not emotional gambling. Ninth, document every investment decision in a research memo. Date it. State the thesis. List the assumptions. Define the catalysts. Set price targets and exit criteria. Attach financial models. File it. Review it quarterly. When you sell, write the postmortem. What did you get right? What did you miss? This is how you improve. This is how you separate skill from luck. Most investors remember their winners and forget their losers. You will do the opposite. You will study your losers because they hold the real lessons. Your memo is your mirror. Look into it, honestly, regularly, ruthlessly. Growth lives there. 10th, accept that analytical investing is a skill, not a shortcut. Takes years to master. It requires continuous learning. It demands emotional discipline. Most who attempt it fail, not because the market is rigged, but because they skip the work. They read one article. They watch one YouTube video. They buy because the chart looks good. That is not analysis, that is astrology. If you are not willing to read 10Ks, build models and track KPIs, stay at level 3. Indexing is honorable. It is profitable. It is sufficient for most goals. Only ascend to level 4 if you are prepared to do the work, and to keep doing it year after year. Mastery is earned, not downloaded. Respect the craft. At level 5, you expand your lens beyond individual securities and portfolio construction. You begin to map the broader economic and geopolitical terrain in which all investments exist. This is not about predicting recessions or timing interest rate moves. It is about recognizing structural forces that shape market regimes, asset class behavior, and long-term return expectations. Ignoring macro is like sailing without a map. You may catch favorable winds by accident, but you will eventually hit rocks you never saw coming. Macro awareness does not mean you become a forecaster. It means you become a scenario planner. You do not predict the future, you prepare for multiple versions of it. This level is about context, understanding why markets behave the way they do, not just how to react to them. The first macro principle: recognize that markets operate in regimes, not in straight lines. Economic cycles, monetary policy, fiscal stimulus, inflation regimes, and geopolitical tensions create distinct environments where certain assets thrive and others suffer. The 2010s were a regime of low inflation, low rates, and quantitative easing, favoring growth stocks and long-duration assets. The 2020s shifted to higher inflation, rising rates, and fiscal tightening, favoring value, commodities, and short-duration bonds. Investors who failed to recognize the regime shift clung to outdated strategies and suffered. You do not need to predict the next regime, but you must diagnose the current one. Read central bank statements. Track inflation expectations, break-evens. Monitor yield curves. Watch credit spreads. These are not noise, they are signals of the underlying economic engine. Second, understand the role of monetary policy not as theory but as mechanical reality. Central banks do not control the economy, they influence liquidity, cost of capital, and risk appetite. When rates are cut and balance sheets expand, risk assets generally rise, not because fundamentals improved, but because money became cheaper and more abundant. When rates rise and QT, quantitative tightening, begins, the reverse occurs. This is not manipulation, it is transmission. Your job is not to debate whether policy is right. It is to understand its impact. Ask, what assets benefit from loose money? What assets suffer from tight money? Adjust your tactical exposure accordingly, without abandoning your strategic core. Policy creates tides. Do not fight them. Surf them with discipline. Third, track fiscal policy and government debt dynamics. Budget deficits, stimulus packages, infrastructure bills, tax reforms, these are not political talking points. They are capital allocation decisions that redirect trillions of dollars, distort incentives, and alter growth trajectories. A massive infrastructure bill boosts industrial and materials sectors. A corporate tax cut lifts earnings until it does not. A debt ceiling crisis increases volatility. You do not need to agree with the policy, you need to model its consequences. Who benefits? Who is burdened? What sectors get subsidies? What assets face new regulation? Fiscal policy is redistribution, and redistribution creates winners and losers. Map it. Position accordingly. Ignore it at your peril. Fourth, internalize the inflation mechanism, not as a headline number, but as a structural force. Inflation is not prices going up. It is a loss of purchasing power driven by money supply growth, demand-supply imbalances, wage pressures, and expectations. Different types of inflation require different hedges. Demand pull inflation, too much money chasing goods, may respond to rate hikes. Cost push inflation, supply chain shocks, energy spikes, may not. Stagflation, high inflation plus low growth, destroys nominal bonds and growth stocks. Hyperinflation, extreme money printing, destroys cash. Know which inflation regime you are in and which assets preserve real value within it. Tips: commodities, real estate, and equities with pricing power behave very differently across inflation environments. Allocate with precision, not dogma. Fifth, monitor global capital flows and currency regimes. Money moves across borders in search of yield, safety, and growth. A strong dollar makes U.S. exports expensive and emerging market debt harder to service. A weak dollar boosts commodities and international equities. Currency strength is not random. It is driven by rate differentials, trade balances, and relative growth. If you hold international assets, you are implicitly holding currency exposure. Hedge it or exploit it, but never ignore it. Track real effective exchange rates. Watch current account balances. Follow central bank FX interventions. Currency moves can wipe out years of equity gains or amplify them. This is not FX trading. It is risk management for global portfolios. Sixth, assess geopolitical risk as a portfolio factor, not a news story. Wars, sanctions, trade wars, elections, coups, these are not black swans. They are recurring features of the global system. Some assets are fragile to geopolitical shocks. Global supply chain stocks, luxury goods. Others are resilient, defense, gold, local utilities. Build a geopolitical dashboard. Exposure to sanctioned regions, reliance on contested supply chains, revenue concentration in unstable regimes. Reduce concentration where fragility is high. Add hedges where systemic risk is elevated. You do not need to predict the next war. You need to know which of your holdings would bleed if one erupts. Geopolitical risk is not diversifiable, but it is manageable. Seventh, study credit cycles and private sector leverage. Markets do not crash because of PE ratios. They crash when debt cannot be serviced. Track corporate debt to EBITDA. Watch household debt service ratios. Monitor shadow banking and non-bank financial leverage. When credit is abundant and cheap, risk-taking flourishes. When credit tightens, defaults rise and liquidity vanishes. The 2008 crisis was not about housing, it was about leverage. The 2020 crisis was not about viruses, it was about liquidity. The next crisis will be about something else, but it will still be about debt. Position your portfolio to survive credit contraction. Hold high-quality bonds, avoid over-leveraged companies, maintain liquidity. Credit cycles are slower than market cycles, but more destructive. Respect them. Eighth, integrate demographic and technological megatrends into your framework. Aging populations, urbanization, automation, AI, decarbonization, deglobalization. These are not themes. They are structural shifts that will reshape industries, labor markets, consumption patterns, and return profiles over decades. A portfolio built for a 3% global growth world with cheap labor and open borders will fail in a 1.5% growth world with aging populations and supply chain fragmentation. Ask, which assets benefit from aging? Which suffer? Who wins in a decarbonized economy? Who loses? What industries are disrupted by AI? What new ones emerge? These are not speculative bets. They are long-term tilts based on irreversible forces. Align your capital with the direction of history, not against it. Ninth, build scenario-based contingency plans, not forecasts. You cannot predict the future, but you can prepare for plausible versions of it. Define 3 to 5 key macro variables that matter most to your portfolio. Inflation, rates, growth, geopolitics, regulation. Assign ranges, not point estimates. Build portfolios for each scenario: high inflation plus low growth, deflation plus QE, geopolitical shock plus safe haven demand. Stress test allocations. Identify hedges. Predefine triggers for tactical shifts. This is not market timing, it is adaptive positioning. When the regime shifts, you do not panic, you execute your pre-built plan. Scenario planning turns uncertainty from a threat into a framework. It replaces fear with preparedness. 10th, accept that macro awareness is not about being right. It is about being robust. You will be wrong often. Central banks will surprise you. Data will contradict your thesis. Events will unfold unpredictably. That is fine. Your goal is not to predict. It is to survive any outcome with acceptable losses and asymmetric upside. Hold uncorrelated assets. Maintain optionality. Preserve liquidity. Avoid single-point failures. Macro is not a crystal ball, it is a shock absorber. The best macro investors are not the loudest forecasters. They are the quietest survivors. They do not try to win every battle. They ensure they are still standing after the war. At level 5, you stop chasing returns and start engineering resilience. That is the real edge. At level 6, you turn inward. All the strategy, analysis, and macro insight in the world mean nothing if your psychology sabotages execution. Markets are not rational, but your response to them must be. Behavioral investing is not about controlling the market. It is about controlling yourself. It is the recognition that your greatest enemy is not volatility, inflation, or recessions. It is your own brain. Cognitive biases, emotional triggers, and social pressures will distort your judgment, override your systems, and destroy your returns, unless you architect defenses against them. This level is not optional. It is the gatekeeper to everything above it. You can be brilliant analytically, but if you panic sell in a crash or FOMO buy at a peak, you are still a novice. Mastery begins between your ears. The first behavioral rule. Recognize that loss aversion is your default setting. You feel the pain of a $1,000 loss twice as intensely as the pleasure of a $1,000 gain. This is not weakness, it is evolutionary wiring. But in markets, it is catastrophic. It causes you to sell low to stop the pain and avoid buying low because it feels risky. The solution is not to toughen up. It is to reframe. View volatility not as threat, but as opportunity. View drawdowns not as failure, but as discount sales. Write this down. My portfolio will drop 30% plus multiple times in my life. That is not a bug. It is a feature of equity returns. I will not react. I will rebalance. Repeat it. Internalize it. Loss aversion cannot be eliminated, but it can be neutralized by pre-commitment to process. Second, defeat recency bias, the tendency to overweight recent events. After a bull market, you feel invincible and take more risk. After a crash, you feel scarred and avoid risk. Both are wrong. Markets are cyclical, not linear. What just happened is not what will happen next. Force yourself to look at long-term data, not headlines. If stocks just crashed, look at 10-year return charts, not 10-day. If crypto just mooned, study its 5-year volatility, not its last pump. Create a recency antidote document. Historical drawdowns, recovery times, long-term averages. Consult it before every major decision. Recency bias turns investors into emotional weather vanes, spinning with every breeze. Your job is to be the anchor. Third, eliminate confirmation bias, the tendency to seek information that supports your existing beliefs. You read bullish reports on stocks you own. You ignore bearish data. You follow analysts who agree with you. This is intellectual suicide. Actively seek disconfirming evidence. Assign a devil's advocate role in your process. Before buying, write down 3 reasons this could fail. Before selling, write 3 reasons this could recover. Subscribe to opposing viewpoints. Read short seller reports. Study failed companies in your sector. Confirmation bias creates blind spots, and blind spots get exploited. The market does not care what you believe. It only cares what is true. Seek truth, not comfort. Fourth, neutralize herd behavior, the urge to follow the crowd. FOMO is not a millennial meme. It is a biological imperative. We are wired to conform. In markets, conformity is ruinous. Bubbles form because everyone is buying. Crashes deepen because everyone is selling. Break the spell. Ask, am I doing this because it is rational, or because everyone else is? Would I still buy this if no one knew I owned it? Create isolation protocols. Make decisions offline without checking social media or news. Wait 72 hours after everyone is talking about it. Herd behavior feels safe in the moment and catastrophic in hindsight. Be the contrarian, not by default but by discipline. Fifth, manage overconfidence, the silent killer of experienced investors. The more success you have, the more you believe your skill caused it, not luck, timing, or regime tailwinds. Overconfidence leads to concentrated bets, leverage, and abandoned processes. Combat it with humility rituals. After every win, write, what part of this was luck? After every loss, write, what part of this was skill failure? Track your prediction accuracy, not just returns. Most investors are right less than 60% of the time, yet believe they are geniuses. Data does not lie. Ego does. Schedule quarterly humility audits. Review mistakes. Reread your worst calls. Overconfidence grows in silence. Kill it with light. Sixth, design decision architecture, not willpower. Willpower fails. Systems endure. Remove temptations. Block financial news sites during market hours. Uninstall trading apps from your phone. Set hard limits on position sizes. Automate rebalancing. Use commitment devices. I will not trade on Fed days. I will not check my portfolio during market hours. I will not read Twitter before 6 p.m. Your environment shapes your behavior more than your intentions. Design an environment that makes good decisions automatic and bad decisions impossible. This is not restriction, it is liberation. You free your future self from your present impulses. Seventh, practice premortems, not postmortems. Before executing any major investment, imagine it is 1 year later and the investment failed spectacularly. Write down, why did it fail? What did I miss? What assumptions were wrong? This surfaces hidden risks before you commit capital. It forces you to think in reverse, which bypasses optimism bias. Premortems are not pessimism, they are probabilistic realism. They turn blind spots into checklists. Do this for every position over 5% of your portfolio. Do it for every tactical shift. Do it for every new strategy. Failure is inevitable, but preventable failure is optional. Premortems are your vaccine. Eighth, measure emotional state, not just performance. Keep a simple 1 to 10 scale. How anxious am I about my portfolio today? Track it weekly. If it is consistently above 7, you are taking too much risk, reduce exposure. If it is below 3, you may be too conservative, consider increasing equity allocation. Your emotional state is a leading indicator of poor decisions. Anxiety precedes panic selling. Boredom precedes reckless gambling. Do not ignore your feelings. Diagnose them. Use them as data. Adjust your portfolio to fit your psychology, not the other way around. Investing is not about becoming emotionless. It is about aligning your portfolio with your emotional capacity. Mismatches destroy discipline. Ninth, create accountability structures. No one performs well in isolation. Share your strategy with a trusted peer, not for advice but for accountability. Join an investment group. Hire a coach. Report your decisions monthly, not your returns, your process adherence. Public commitment reduces deviation. Shame is a more powerful deterrent than logic. Use it. Record video diaries during market stress. Here is why I am not selling. Watch them later. Accountability turns private discipline into public contract. It raises the cost of breaking your own rules. And that cost is what keeps you honest when no one is watching, especially yourself. 10th, accept that behavioral mastery is lifelong, not a milestone. You will never graduate from this level. Biases evolve. Stressors change. Success breeds new overconfidence. Failure breeds new fear. The work never ends. Schedule quarterly behavioral reviews. Reread your worst decisions. Retake bias assessments. Refresh your safeguards. The greatest investors are not those with the highest IQs. They are those with the most robust behavioral systems. They know they are flawed and they build fortresses around those flaws. At level 6, you stop fighting your nature and start engineering around it. That is not weakness. That is wisdom. And it is the only thing that lets you access everything above. At level 7, you stop thinking like an individual investor. and start thinking like a fiduciary. This is not about managing your money. It is about stewarding capital with institutional discipline, governance, and infrastructure. At this level, investing is no longer a side activity, it is a structured operation. You implement formal governance, an investment committee, even if it is just you, written policies, risk controls, audit trails, and performance attribution. You do not chase returns, you engineer outcomes. You do not react to markets, you execute a documented, reviewed, and approved strategy. This is the level where amateurism dies and professionalism is born. The first institutional principle: establish formal governance. Even if you are a one-person operation, create an investment committee charter. Define roles. Who makes decisions, who reviews performance, who audits compliance. Even if you wear all hats, document the separation. Schedule quarterly committee meetings with agendas, minutes, and action items. Review adherence to IPS, performance versus benchmarks, risk exposures, liquidity status, tax efficiency. This is not bureaucracy, it is accountability. Governance creates distance between emotion and execution. It forces you to justify decisions not to others but to your future self. Most individual investors operate in chaos, reacting, rationalizing, regretting. You will operate in structure, deciding, documenting, reviewing. That is the difference between gambling and stewardship. Second, implement enterprise-grade risk management, not spreadsheet tracking. Move beyond how much did I make to what risks did I take to make it. Use risk dashboards that track volatility, drawdowns, factor exposures, concentration risk, liquidity risk, currency risk, counterparty risk. Set hard limits. Max 20% single sector exposure. Min 5% cash buffer. Max 2 times leverage. Automate alerts when thresholds are breached. Review risk reports monthly, not P&L statements. Risk is not an afterthought, it is the first thought. Institutional investors do not avoid risk, they measure it, price it, and control it. You must do the same. If you cannot quantify your risk, you do not own it. You are hostage to it. Third, adopt performance attribution, not just total return. Understand where your returns came from. Asset allocation, security selection, currency, timing. Did you outperform because you picked great stocks, or because you overweight a hot sector? Did you underperform because of bad picks, or because your strategic allocation was wrong? Attribution separates skill from luck and reveals hidden biases. Use Brinson-style attribution for multi-asset portfolios. For single stocks, decompose into sector beta, factor exposure, and idiosyncratic alpha. This is not vanity, it is diagnosis. You cannot improve what you do not measure. Attribution turns vague, I did well, into precise. I added 1.2% through value tilt and lost 0.8% through tech underweight. That is how you refine. Fourth, build redundancy and succession planning even for a solo portfolio. Document everything. Account locations, passwords, beneficiary designations, strategy summaries, contact info for advisors. Store it securely and share access with a trusted executor. Assume you will be incapacitated. Is your portfolio frozen? Are instructions clear? This is not morbidity, it is responsibility. Institutional portfolios survive leadership changes. Yours should too. Create a black box file. One document that explains everything needed to jig on your portfolio. Update it annually. Test it. Ask someone to read it and explain your strategy back to you. If they cannot, simplify it. Legacy is not about size, it is about clarity. Fifth, integrate liability matching, not just asset growth. If you have known future liabilities, college tuition, home purchase, retirement withdrawals, structure dedicated portfolios to fund them. Use bond ladders, tips, or target date funds that mature when cash is needed. This is called asset liability management, ALM. It removes market timing risk from critical obligations. You do not want to sell equities in a crash to pay for tuition. You want a bond maturing that month. ALM turns abstract goals into concrete cash flows. Calculate each liability's present value. Fund it with matching duration assets. Rebalance only for drift. not for performance. This is not conservative, it is precise. Precision beats hope. Sixth, use overlays and derivatives for risk control, not speculation. You do not need to trade options, but you can use them defensively. Buy puts as portfolio insurance. Sell covered calls to generate income in flat markets. Use futures to hedge currency or equity exposure without selling assets. This is not Wall Street gambling. It is institutional risk transfer. Done right, derivatives reduce volatility, protect capital, and enhance tax efficiency. Start simple. One protective put per year on your equity sleeve. Scale only with competence. Never use leverage. Never sell naked options. Derivatives are tools, not toys. At this level, you use them like a surgeon, with precision, purpose, and sterile discipline. Seventh, implement tax alpha strategies, not just tax efficiency. Go beyond asset location. Harvest losses systematically, not emotionally. Use tax loss harvesting software or robo-advisors to automate it. Consider donor-advised funds for charitable giving. Donate appreciated stock, not cash. Use qualified charitable distributions, QCDs, from IRAs after 70.5. Explore opportunity zones for deferred gains. Tax alpha is real, 1 to 2% per year in added after-tax return. That compounds massively, but it requires planning, not reaction. Schedule annual tax strategy sessions with a CPA, not during tax season, but in July. Plan ahead. Optimize deliberately. Taxes are not a cost of doing business, they are a design parameter. Master them. Eighth, outsource non-core functions but retain control. You do not need to pick every stock, but you do need to select and monitor your managers. Use low-cost, rules-based ETFs for core exposures. Hire specialized managers via SMA or mutual funds for satellite strategies, but only if they add verifiable alpha after fees. Audit them quarterly. Adherence to mandate, risk controls, fee drag. Fire underperformers ruthlessly, not emotionally. Outsourcing is not weakness, it is focus. You focus on governance, risk, and strategy. Let others handle execution, but hold them accountable. The best institutions do not do everything, they orchestrate everything. Be the conductor, not the entire orchestra. Ninth, stress test for black swans, not just recessions. Run scenario analyses for hyperinflation, currency collapse, market closure, cyber attack, custodial failure, regulatory seizure. These are not crazy. They have all happened somewhere, recently. Hold physical gold. Allocated. Audited. Keep 1 to 3% in Bitcoin cold storage as digital optionality. Maintain accounts in multiple jurisdictions. Use multiple custodians. Keep paper statements. Assume digital systems will fail. Black swans are not predictable, but their damage is reducible. Resilience is not paranoia, it is prudence. Institutions plan for tail risks. You must too. Not because they are likely, because they are existential. 10th, accept that institutional investing is not about complexity. It is about robustness. You do not need Bloomberg terminals or 50-page reports. You need clear policies, hard limits, documented processes, and redundant systems. Complexity is the enemy of execution. Robustness is its friend. The goal is not to impress. It is to endure. Markets will test you. Life will interrupt you. Emotions will betray you. Your systems must survive all three. At level 7, you stop being an investor and start being a steward. You are no longer playing a game. You are running an institution. And institutions outlive individuals. Build yours to last. At level 8, you no longer invest just for financial return, you invest for legacy, impact, and multidimensional value. This is not ESG virtue signaling, it is sovereign capital allocation. Deploying wealth to shape outcomes beyond your personal balance sheet. You think in generations, not quarters. You measure success not just in IRR but in influence, resilience, and meaning. You become a node in a larger system, funding innovation, preserving ecosystems, empowering communities, and building structures that outlive you. This is not charity, it is strategic capital deployment with non-financial KPIs. You are no longer a participant in the market, you are a shaper of systems. This is the highest level, not because it is complex, but because it is consequential. The first sovereign principle: define your beyond financial KPIs and track them rigorously. What legacy do you want to leave? What systems do you want to strengthen? What problems do you want to solve? Define measurable outcomes. Fund 10 startups in climate tech by 2030. Preserve 500 acres of forest in perpetuity. Provide scholarships for 100 first-gen students. Build a community center that serves 5,000 people per year. These are not vague aspirations, they are investment theses with deliverables. Allocate capital to them with the same rigor as your financial portfolio. Set budgets. Track progress. Audit outcomes. Impact without measurement is sentiment, not strategy. Second, integrate intergenerational time horizons, not just your lifetime. Structure trusts, foundations, or donor-advised funds that operate beyond your death. Define governance rules for successors. No changes to the mission for 50 years. 70% of distributions must fund education. Board must include beneficiary representatives. Time is your ultimate leverage. A dollar deployed today with a 100-year horizon compounds differently, not just financially but socially. You are not managing wealth, you are designing civilizations. Think like a cathedral builder. You will not see the completion, but you lay stones that will. Document your intent. Codify your values. Make them legally binding. Legacy is not hope, it is architecture. Third, deploy capital as a tool for systems change, not just individual gain. Invest in regenerative agriculture to rebuild topsoil. Fund modular housing to solve homelessness. Back open-source AI to prevent corporate monopolies. Capital is not neutral, it has direction. Every dollar you deploy votes for a future. Choose deliberately. Avoid impact washing, superficial ESG funds that change nothing. Go direct. Fund what you believe in with due diligence, governance, and exit strategies. This is not philanthropy, it is patient, strategic, return-aware capital with non-financial primary objectives. Measure social ROI. Lives improved, carbon removed, jobs created. Track it, report it, improve it. Fourth, build anti-fragile structures, not just resilient portfolios. Anti-fragility means your legacy grows stronger through stress. Design entities that benefit from volatility. Community land trusts that acquire distressed properties. Education funds that scale during recessions when need is highest. Disaster response pools that deploy faster when systems fail. Do not just survive chaos, harness it. Study Nassim Taleb's principles: redundancy, optionality, decentralization, skin in the game. Apply them to your legacy structures. A fragile legacy breaks under pressure. A resilient one survives. An anti-fragile one thrives. That is your goal. Fifth, decentralize control but not accountability. Avoid dynastic traps where heirs mismanage or dilute your mission. Use independent boards, sunset clauses, beneficiary councils, algorithmic governance, e.g., blockchain-based voting for fund allocation. Distribute authority but anchor it to your core principles. The goal is not to control from the grave. It is to empower stewards who share your values. Write letters from the future, video or text messages to be released at key decision points. Embed your voice, not your veto. Sovereignty is not domination, it is catalytic influence. Design systems that outthink you. Sixth, measure total return, not just financial. Create a dashboard that tracks financial ROI, social impact, environmental regeneration, cultural preservation, knowledge dissemination. Assign weights. Review quarterly. Did you generate 8% return, but fund a company that polluted a river? Net negative. Did you earn 4%, but enable 100 families to own homes? Net positive. Total return accounting forces holistic thinking. It reveals trade-offs. It aligns capital with conscience. This is not soft, it is sophisticated. The most advanced investors do not ignore externalities, they internalize them. You must too, because in the end, all returns are social. Seventh, embrace patient, illiquid capital, not just liquid markets. Deploy into real assets. Land, infrastructure, intellectual property, community enterprises. These do not trade daily, but they compound value in ways markets cannot capture. A forest appreciates in timber, biodiversity, carbon credits, and watershed protection. A community center appreciates in social cohesion, crime reduction, and economic mobility. Illiquidity is not a flaw, it is a feature. It forces long-term thinking. It reduces speculative churn. It aligns incentives. Structure exits, but not for quick flips. Plan for 20 to 50-year horizons. Let value mature, like wine, not soda. Eighth, collaborate, do not compete. Pool capital with aligned sovereigns. Join syndicates funding moonshots. Co-invest with foundations, family offices, impact funds. Share due diligence. Standardize metrics. Reduce duplication. The biggest problems, climate, inequality, pandemics, cannot be solved alone. Your capital is a node in a network. Amplify it. Leverage it. Connect it. Avoid ego. Seek partners who complement your gaps. Sovereignty is not isolation, it is coordinated autonomy. Build alliances. Share power. Multiply impact. Ninth, prepare for irrelevance gracefully. Your views will age. Your solutions will become outdated. Your structures may need to evolve. Build feedback loops, beneficiary surveys, third-party audits, adaptive governance. Allow your legacy to morph without losing its soul. Include mutation clauses in legal docs. If mission becomes obsolete, board may redirect 80% to nearest aligned cause. Do not fossilize your wisdom, make it living. The goal is not to preserve your ego, it is to serve future needs. Let go. Trust. Evolve. True sovereignty is not control, it is release. 10th, accept that level 8 is not a destination. It is a responsibility. You are no longer investing for yourself. You are investing for the world you want to exist after you are gone. This is not altruism, it is enlightened self-interest. The market is a tool, not a purpose. Money is a scorecard, not a meaning. At this level, you stop asking, how much can I make? And start asking, what world do I want my capital to build? That is the final evolution. Not from novice to pro, but from accumulator to architect. From player to steward. From participant to sovereign. You do not beat the market, you transcend it. And in doing so, you leave something that lasts. That is the ultimate return. If this framework resonated with you, if you are ready to move from reactive investing to sovereign stewardship, then take action now. Subscribe because we break down advanced investing layers every week. Like this video, it tells YouTube this content matters. Hit the bell so you never miss a deep dive. Comment below. Tell me, which level are you on? And what is your next step? I read every response. This is not just theory. This is your roadmap. Start where you are. Build one level at a time. And remember, mastery is not about complexity. It is about consistency. You have got this. Now go execute.